I mean, come on now. If you're not willing to spend $850,000 to raise a couple $1 million, there's something wrong with you.
All right, welcome to the Radical Hospitality Podcast. I'm your host, Zeke Freeman. Super excited today. I've got none other than Brad Blazar. He is a capital raising, just mega machine superstar. Has been really helpful in our journey. So I'm going to hop in today and we'll start to ask some questions that hopefully help you guys in your projects and capital raising journeys. So a little bit of background on him. Brad Blazar, he's a renowned capital raising expert. He's an entrepreneur, author, and speaker. I've got a couple of his books here that have been very helpful. Winning at the Game, On the Wings of Eagles, and Put Some Thrive in Your Hive. So he runs these capital school boot camps, which is where I got a chance to meet Brad out in Austin. It was a 2-day, very intensive boot camp, as well as an ongoing educational platform and coaching programs. So welcome, Brad. I'm really excited to have you today.
Thanks, Zeke. Well, I'll tell you, holding up those books, I kind of felt like I was on a TV show with Ellen DeGeneres or something where they're pulling up baby pictures or stuff. But it's great to be here.
Oh, well, it's a lot of work to put in and get books done. And, it kind of packages up those journeys. So well done on getting all of that put together. So Brad, I'd love to just kind of start with a little bit of background. If you could kind of maybe tell our audience of how you got into capital raising, and maybe just give us a little update.
Yeah, it's a pretty interesting story. I grew up in a typical middle-class family like a lot of people, and both my parents worked. My dad was an executive and worked in the real estate industry. My mom was pretty much a housewife until me and my siblings got older, and then she went to work in Dallas, Texas as a realtor. But how I got into kind of what I'm doing today was really by circumstance. I grew up and as I matured, wanted to be an architect. And so I went off to college studying architecture and got into it 4 years, almost graduated 4 years into what is a 5-year program. And in Austin, in my senior year, I was just looking to get a job, help pay some of my college costs and make some money. And responded to an ad in the local newspaper for a small oil company. And they were looking to hire a person onto their team to come on and start building relationships with affluent, wealthy individuals that would ultimately invest in their drilling programs. And so, I don't know what the CEO saw. It was a little 21-year-old cocky, confident kid, probably didn't know any better, but he said, hey, if you can come in here between class and after school, we'll teach you a system, we'll pay you a commission. And so I had to get my, what they call a Texas Securities license. And they showed me how to do that and then became licensed and started getting on the phone. And got real good just talking to people, building relationships. And, here I was working probably, 12 to 15 hours a week. And I was making 6 figures. And I'm like, holy cow, what in the hell am I doing going to college to get a degree so I can go out into corporate America and make my 50, 60,000? I'm making more than that. I'm only working part-time. So I went to work for a second company doing exactly the same thing, only to find out through one of the investors that was a petroleum engineer that did a little bit of investigative work before he invested that I was working for a bunch of criminals. And so I don't want to go into details, but I immediately resigned and organized all my investors to file a class action suit, which we ultimately prevailed in. But most of the investors that I had sourced Seek, because this was before, the advent of the internet, this goes back to the mid 1980s and the late 80s, they had no idea I was a 23-year-old kid. And so they're like, what are you going to do now, Brad? And I'm like, I don't know. And they're like, why don't you just do the same thing, but just do it with some honesty? And so I saw this huge door open and just basically dropped out of school, became a college dropout, didn't tell my parents what I was going to do, printed up some letterhead and some business cards and got off on a petroleum engineer and a landman. And before I knew it, I was running a small oil company with about 35 employees on my payroll. And so that's really where I learned how to raise capital and build a team and, grow a business. And looking back, it's kind of odd because when I made the decision to do that, I knew absolutely nothing about drilling an oil well. I knew nothing at all about running a business. But I hired a team of professionals, got the lawyer, got the CPA, got the salespeople, et cetera. And so we were blowing and going for about 12 years. until the shit hit the fan. And oil prices plummeted. The tax law in 1987, Tax Reform Act of 87, took away most of the incentives for investment capital, just kind of evaporated. And so that's when I went back to school to finally finish my degree. And when I came out, I had this nice little diploma, graduate, BBA in finance. I changed majors midterm because I figured, hell, after running a business for a decade, you might as well get a business degree. And literally was disillusioned, Zeke, because people wanted to hire me, but here I was getting offered salaries close to what I would make in a good month. And so I was literally just struggling for about a year and a half. Like, what am I going to do? Shit, should I become a doctor? Maybe I'll go to law school, become a lawyer. And I started to realize I was doing those things for all the wrong reasons. I didn't love law, certainly didn't want to be a doctor for the love of medicine. It was more for the money and what I had become accustomed to. And so one day, here I am watching TV, and somebody on TV is talking about this concept of finding what he called your something special. He said, everybody here in the audience has this primary unique talent. It's what I call your something special. And if you can figure out what that is and package it up where it solves a major problem in the world, it can become very valuable to you. And about a week and a half later, as I was on my patio, it was like, holy crap, my son's specialist. I know how to raise millions of dollars.
Mm-hmm.
And that is a big problem. And I bet you a lot of entrepreneurs and a lot of business owners would pay me a lot of money for it. And so I went to work basically in the financial services and the real estate industry as a hired professional capital raiser. And, over the course of a career, working as the head of markets and the national sales director for what are today some of the world's largest real estate investment firms or some of the world's largest financial services firms, really learned how to raise capital at scale. And I'm talking about being able to put together a small team of 3 or 4 people where we raise 150, $200 million in 12 months. And so when I kind of semi-retired, I started getting calls from people. Hey, we're trying to do this. Can you consult us? Can you help us? And so I decided to kind of come out of retirement, so to speak, and put together the whole Capital School platform. I wrote a couple books, and this whole thing's just kind of taken off way beyond my belief to grow to what it ultimately is today. And just find a lot of pleasure in knowing that my knowledge can help build people's future. That's really what I tell people. You're paying for my knowledge because my knowledge and all of the things I've done is what you're going to use to help build your future. And so, when people come to us with a dream like you did, right? You had a dream to build your hotel. It's just laying out the systems, laying the blueprint that they have to follow. And then if they show up and they do the work, voila, capital is raised.
That's fantastic, Brad. So I love how you guys have set up something that you did at a big scale. And sometimes it is harder to do smaller capital raising than it is big capital raising for multiple people. And so teaching first-time capital raisers how to do that is a different thing. Laying out the blueprint, like you said. So that was some of the things when we came to you guys in Austin and started figuring out how to put together capital for a project that we designed. And, funny enough that you kind of came out of the architecture world and ended up in capital raising. And here I've gone through the architecture world and I'm coming back to the capital raising.
Yeah.
Because at the end of the day, capital raising is really nothing more than putting together the people who have learned to invest and believe in you all along the way to now take out your dreams and put those out there and allow other people to have an opportunity to participate in that. And so getting the confidence and the systems and the blueprint was really important for us to start figuring out how to walk through that, how to do it with integrity, how to do it in a professional manner so that if we're taking other people's capitals, that we're able to do that in a way that we can do it with integrity and have the systems in place to make sure that, we're managing that resource in a way that is, very well taken care of. So maybe walk us through a little bit what your blueprint is and what you guys teach and maybe just a high level through capital raising school.
Sure. It really starts with laying the foundation. What people have to realize is when they take somebody else's money and that other person is investing with you in a passive role, you're in the securities industry now. And so, as you can imagine, there's a whole body of regulations. The SEC, various states have regulations, obviously, at the state level, that we need to be aware of. And so the very first thing we do is we talk about the regulatory environment and understanding this so that you don't step on a landmine and you don't do something inappropriate that will get you in a lot of trouble. Once we lay that foundation, it then really moves forward to, well, how do we attract the attention of investors? How can we leverage social media? And when we have their attention, what do we say? How do we pique their interest? And the biggest mistake I think that a lot of people make when they raise capital or when they are trying to raise capital is like they have a deal, right? You've got your nice little pitch deck and you're real proud and excited about it. You need to raise the money. And so you start meeting people and you're guilty of what I call randomness in motion. Like you're talking to people and you're sending stuff out and you think it's going to eventually lead to a lot of money being raised, but in reality, it's not. And so you get very frustrated after 3 or 4 months going, what am I doing wrong? Why am I not raising any money? It's because you're not following a proven system. You're not doing it the right way. And the biggest mistake people make typically is they send out the pitch deck or they start talking about the opportunity with people that do not yet know them way too early in the process. Put yourself in the investor's shoes. If somebody is calling you and pitching you on a deal in the first or even on the second call, when they're done pitching, what are you normally going to say? You're going to say, "Oh, Zeke, sounds like a pretty interesting investment opportunity. Send me some information. I'll take a look at it." Well, they're just saying that to be polite. That's what everybody says. And so you send them everything, and then you follow up, and then they never invest. And you're like, what's wrong? Well, what's wrong is they don't trust you. It's pretty simple. You just met. It's like going on a first date and then asking a lady to go out and marry you. It don't work that way, right? There's a courtship process. So I like to use this term. I say, you got premature presentation. You pitch the deal way too early, buddy. Slow down and speed up. And so realize that there is this process of laying a foundation of trust. Ask questions, listen, ask them about their investment past, what their time horizon is, what they're trying to get their money to do. And one of the things I talk about in this thing that you learned, of course, at the boot camp, which is the trust sequence, is there's really 6 steps that people go through. The first thing is they meet you and they create a perception. Perception creates the investor's reality. Do they like you? Do you look professional? Do you look like a mom and pop operation? Or do you look like a reputable capital raiser? And then once they move beyond that, our job is to uncover the temptation. Everybody has a need for their money to do something. They're looking for the money to grow to retire. They're looking for the money to grow to put kids through school. They're looking to make their money grow so they can buy a second house as a vacation property. And if you can find out what that is, hopefully, as you're asking questions, when you're finally pitching at some point in the future, you can match the benefits of that investment to their need, right? So imagine, for example, you're trying to put your kids through school. And I say, hey, Zeke, can you see how this investment is going to help you put those kids through school in the next 4 to 6 years? The growth and the appreciation. And Zeke's like, yeah. See, money exchanges hands when problems are solved, and people are willing to invest if they see that what you're really proposing is a solution to their problem. That way, we're not chasing people, we're not selling people, we're solving a problem for them, which is here's how your money can grow, or here's how your money can generate income, or here's how you can invest and get some considerable tax relief. And so by listening to people, we really become good capital raising problem solvers. Yeah. And so that's one of the things, of course, that we talk about and teach in our platform at Capital School, but it goes way beyond that. As you know, we have created basically a full service platform from A to Z to help people not only raise capital, but also put together their pitch decks and presentations. And for those people that have a need, we have 5 law firms that we partner with that do the legal work to actually help people launch funds and provide that turnkey offer where they just focus on their business and we do everything else. And in about 4 to 5, 6 weeks later, their fund is effective, they're up and running, and they're off to the races.
So what are some of the key places that you think help build these investor relationships before you actually need them?
I think that you want to start building relationships and start cultivating investors before you need the capital. Like if you need the capital and then you're starting, it's too late because it takes time. But today we live in a environment where we can leverage social media. So we can go on Facebook, Instagram, we can host webinars, we can create an ebook. Personally, I believe it's better to go to investor meetups or gatherings where people curate a room full of people and you walk in and you just start introducing yourself to people, you start piquing their interest. And then, of course, you start following up on the back end of that. It's really understanding that raising capital is simply taking people and it's like putting them on a conveyor belt. There's going to be an introductory process, call, meet up, whatever, getting to know them. Then there's going to be a second meetup. Did you get the information? Do you have any questions? Do you like what we're doing? Would you like to be put on a list so that we can call you when we have an opportunity or an opening? And that's when you finally call and pitch. And then there's another call, usually about a week later, to hopefully bring closure to that process. And so then you just rinse and repeat this, and you recycle it as you're talking to not one, but now many investors. And so understanding that is really how you scale your capital raising. Another more advanced strategy, which really allows people to scale and raise considerably more, is understanding you may have to physically call and talk to 100 people to find those needles in the haystacks, which are maybe the 5 to 8 or 10, whatever that number is, that will ultimately invest, because some of them are not going to be accredited. Some of them are going to tell you, hey, it's just not the right time for me, Zeke. I just invested in this deal a month ago and I'm tapped out or whatever. What I have found is that if you can focus time on the one person that already has 100 relationships with the investors you're trying to get yourself in front of, that's a much better use of your time. And so let's start thinking about who those people are. They're CPAs in your community. They're the small boutique registered investment advisors that manage people's portfolios and money. And so get to focus on them. And then once they go through that due diligence process of getting to know you and understanding the project, they might surprise you and say, Zeke, let me get 20 of my better clients together that I think this is suitable for. And you come in and you present this great hotel opportunity, then I'll do all the work on the back end and I'll meet with each family. We'll figure out how much they want to allocate to this, and voila, that 1 or 2 hours of your time could easily be $3 to $5 million in the next 2 to 3 weeks. See, because that person already has the trust of all of these people. And when you walk in, you don't have to build the credibility or the trust with that audience. He's doing it for you. He's saying, hey, my firm or me, we vetted Zeke, we vetted his company. He's a great guy. And all you are is the opportunity that that person wants to make available to the clients whose money they effectively manage. That's working much smarter.
Yeah, I
And
like
so
that.
that's a little bit more advanced strategy,
Yeah.
but those that bring that model into their capital raising can literally see a 5 to 10x explosion and a quantum leap in the amount of money that they're raising, because now you're soliciting and you're leveraging the help of other people. You see that?
What are some of the mistakes that people make when communicating to potential investors, or how should we be talking to potential investors at these meetups or country club conversations? How should those conversations go and not go?
Well, I think one mistake that I commonly see a lot of people make is not really having a very, very good elevator pitch, or I call it an
Mm.
explanation of service. When we're at networking events or at a social gathering, it's very natural for people to ask us what we do for a living. And a lot of times we tell them, but we don't tell them in a compelling way. For example, if I was a CPA, or if I was an attorney, or if I was a doctor, and somebody said, what is it you do for a living? I'm a certified public accountant, or hey, I'm an attorney. There's really nothing compelling in that that would inspire people to want to spend or invest time with me. So, what people really want to know when they ask that question, and more importantly, what will drive them to a meeting, is answering what you can do for them. They want to know what you can do for
Mm.
me. And so, here I am, 3-time author, keynote speaker, coached literally thousands of people around the world, real estate entrepreneur. When people ask me, Brad, what do you do for a living? Do I tell them that? Hell no. I step back and I pause. And I say, what I do is I teach people how to quit exchanging their time for money. We call that having a job, and it's something that most people are sick and tired of. And the way that we do this is we buy businesses and we invest in assets that generate passive income. And the best part about it? We get to do that, Zeke, with other people's money. Might that be something you'd like to learn something about? Nobody's ever said no to that. You see, and then I say, look, I'm hosting a free webinar next week, or I'm hosting a boot camp, or I've got a whole ebook on this very subject. Can I send that to you? And so Grant Cardone made a statement when I saw him speak many years ago. he said, money follows motion. And he said, you have to think about how you can move somebody forward to something in the future, right? So I'm doing a webinar, I'm doing a boot camp, or I'm hosting an investor meetup. If that piques your interest, come to my event. Let's connect. Let's do something together. But you see what I did in explaining what I do for a living? I explained it on terms that resonate with that other person where they're like, I got to connect with that dude.
Hmm.
Can I
Yeah.
treat you to a cup of coffee? Can I buy you lunch tomorrow? Because what you just said really resonates me at a level, which is what I've been looking for the last 10 plus years. I just haven't been able to find that person or that coach that can actually show me how to do that. So that's what I do, plain and simple. But I package it in a elevator pitch or an explanation of service that resonates with that other person, so that now it becomes a capital raising hook or capital raising tagline or whatever you want to call it. But that's, I think, one of the big mistakes that people make is they don't
Yeah, that
really.
makes a lot of sense. I mean, people are interested in, what can you do for me? And if I'm, always tell them just about me, at some point people will start to glaze over. So,
Exactly.
you know, learn to listen, learn to help.
Mm-hmm.
What do you see as some of the marketing activities and trends that work when capital raising these days? You
Yeah.
mentioned social media webinars. What are the things that are actually being effective?
Well, I think those things are still, very effective if used properly. I think that the best thing any one of us could do is host an investor meetup,
Mm.
organize an event, or go to an event that's curated that puts you in the right environment. There's nothing better than meeting people, shaking their hands, spending 20, 30 minutes talking to them, building a relationship with them, and then obviously following up in 48 hours to just continue the process. So I think that that in and of itself is just hosting an event in your local market, which is real simple to do. We do events here in Houston. As a matter of fact, I'm doing another one next week. And we call it Cool Nights with Wealthy People. Come hang out with us, have some wine, have some appetizers and hors d'oeuvres. The last event we did, we had, I don't know, about 30 people show up, but we had 42 people that actually registered. So what is that? That's 42 new investor leads that we're putting through our system. Now, granted, some people are not going to be interested. Some people are not going to be accredited, but those that are, we focus in on. And out of that one little event, maybe we'll raise 1.5 to, I don't know, a couple $1 million, but then we do another one. And then we do another one. So we keep that pipeline of activity full. The other thing is, in addition to hosting my own event, and by the way, these events are very inexpensive. I'm not serving a big fancy dinner. I mean, I see a lot of these big financial advisory firms. I get the invitations in the mail, I'm sure, like many other people do. Hey, come join us at XYZ Steakhouse for learning about your social retirement benefits or whatever. I mean, this is a 2,500 dinner that, some knucklehead financial advisor is hosting to try to build his business. My entire event I did with wine and appetizers out the door, including gratuity, $850. I mean, come on now. If you're not
Yeah.
willing to spend 850, $1,000 to raise a couple $1 million, there's something wrong with you. But the other is there are industry events that professional companies host where they're reaching out to family offices, they're reaching out to the RIA market, and they're inviting people that are what we call allocators, and also, of course, syndicators, fund sponsors. And so, we can show up, have a table, be called up on stage, pitch our opportunity to a room of 60 or 80 or whatever that number is, people that are there that have the ability to write checks, that manage millions of dollars. So I go to a lot of those over the years. And so it's really just about building the traffic so that you're constantly talking to people and building relationships. If you just sit back and you wait for people to call you, you're going to be waiting a long time. Or if you buy a list and just blast out an email with a pitch deck attached to it, thinking people are going to respond, it ain't going to work that way because they don't know you. Why would they respond? They're just saying, hey, it's just spam, and they delete it. And you're sitting there going, what's going wrong here? Now, emailing does work. So don't get me wrong on that. You send an email with a little teaser, we call it a one pager, but then you got to follow up, in 48 hours. Hey, Zeke, Brad Blazar calling over here from Capital Catalyst. I don't have anything to sell you today. I'm just following up on an email that we sent out a day or two ago. Just wanted to see if you got that. And then you just start, did it pique your interest? Is this something that you actively invest in? And before you know it, you're having a second call and you're having a third call. And then hopefully at some point they're investing in what it is you're actively doing. And so a lot of raising capital is also understanding a lot of, quote, what I call technical things as it relates to the sales process. The better you are in sales, more than likely, the better you are at capital raising. The two just naturally go together.
So one of the things, that is a bit of still mystery in my mind is, when you have an active project, you need to actively raise capital, and there's probably a little bit more urgency to go out and do that.
Mm-hmm.
When you don't have a project, there's a little bit less urgency, but you need to be building those relationships for long term. But it's harder to pitch something when you don't have a project, and it's easier to pitch something when you do.
Right.
In that evergreen time between projects, how are you continuing to build that relationship and nurture those relationships so that when you do have something to put in front of them, that you're ready? And then vice versa, when you have something, how do you go raise capital without being over needy?
Well, I think the first is, number one, to understand that to take somebody that is a stranger, you don't have any pre-existing relationship, you meet them to the point of ultimately investing with you. That's about a 4 to 6 week process. There's an introductory call, then you go to your CRM, you schedule a follow-up about 7 to 10 days later. Then, there's a second call, you're building more trust, building the relationship. And then about a week to 10 days later, there's the pitch, the presentation of an opportunity. And then about a week to 10 days later, hopefully there's answering some questions and bringing closure to this process. So if you look at the fact that each one of these is about, 7 to 10 days apart, and there's 4 to 5, that's about a month. So I tell people it's about 4 to 6 week process. But you always need to be talking to people. And so part of this process is telling people that you appreciate the fact that they're interested, but that right now in the moment, you don't have an opportunity that you can openly share with them. And there's this process in the trust sequence that is ultimately, I think, the most important, which is what we call the validation stage. If you can't validate that other person trusts you enough to move forward to the next step, you're largely just spinning your wheels. You might pitch them at a point, like I said, where they just don't trust you enough. And so by asking a question of that potential investor in such a manner where they say, yes, please do that, what they're really subconsciously saying is, Zeke, I trust you enough at this point to move forward to the next step in this process with you. Would you put me on your list? Call me back at some time in the future when you have something you think I could get real excited about. So, as I'm talking to people and I'm kind of wrapping up my second call or my second meeting, I just say, Zeke, I really enjoyed visiting with you. But like I said, right now, I just don't have a deal that I can openly share. But what I'd love to do is I keep a list of people on my desk that have expressed interest in what we're doing here. And I'd love to just add you to that list and give you a call back at some point in the future when I've got something I think you can get real excited about. Would that be okay with you? And when you say, yeah, please do that, you're very subconsciously acknowledging that you're now ready to move forward. And so what do? I call them back when I got a deal, or I call them back about 7 to 10 days later if I actually have a deal or if I have a fund that is open. And this is when I'm now in pitch mode. But when you look at raising money, a lot of people that are syndicators, where they're raising money for a specific specified deal, I equate capital raising to climbing Mount Everest. So if you're waiting to start raising money when you have a deal, you got everybody here at the bottom of the mountain, and it's a long journey to get everybody to the summit. But if you've been talking to people and they've been climbing the mountain and you got them up here at base camp and then they're halfway up and now you got a deal, it's a much shorter journey. And you have a lot of people that are kind of over here, and kind of what I call that is your pressure cooker. You've been building pressure in this pressure cooker, and all you got to do is take the top off. All these people already know you, they like you, and they trust you. So you can raise capital much quicker. But the secret to that is understanding in sales this thing called linear and nonlinear. Linear is talking to somebody, meeting in person with somebody. A nonlinear follow-up is how we stay relevant and stay present with somebody even though we're not there. So it could be an email, it could be a text, it could be you send somebody something through the US Postal Service that they get. And so you're staying in front of people, dripping on them, so that you're staying relevant. I think that real estate agents are really great at this because most people are not buying and selling homes,
Mm.
every week or even every month. So how does a realtor stay relevant so that in 3 years, when Zeke and his wife are ready to sell, the first person they think of, that dude, Brad Blazar, man, he's setting stuff every other month. Let's call him. He's really good at staying in touch. But you see, that process over time is what built my credibility, what helped build that trust. So I think it's a little bit of that in the capital raising process as well.
So when I came to the workshop last year, I had a nice thick pitch deck, and
Yeah,
and the
I
first
remember
thing you
that.
told me was, Zeke, like, you need to cut that down to about that,
Yeah,
a couple
20
pages.
pages. Yeah.
What do you see as the key things that need to be in a proper pitch deck when you then have a deal that you're ready to put in front of people?
Yeah, so we got a whole outline for this. You got to remember, most successful people, most investors, if you give them what we call a disc profile, they're high Ds. They don't want to sit down and shoot the shit for 2 hours with somebody or hear your whole life story. They just want to know, tell me the deal, tell me who's on the team, talk a little bit about your prior track record or what you've done in the past, and more importantly, how you're going to bring certainty to the outcome here. We had Kevin Harrington speak at one of our events a few years ago, and of course, he said a lot of people come to Shark Tank. As we know, they're smart PhDs, engineers, and then they leave with no deal. And it comes down to just one word. That word is execution. If you can't convince the investor that you can execute on what you're trying to accomplish or achieve, why in the world would they invest, right? And so it's a team sport. And so, in a really well put together presentation, you start off with number one, the problem that you're trying to solve for, or what is the problem. Could be a problem with the local market, could be a problem with housing. In your case, could be a problem with the inavailability of rooms. Number two, of course, is you talk about solving for that or the why. And then you go into things specifically, maybe the demographics of where that is. It could be, of course, the team. You talk about potential returns, you talk about structure to the investor, and then typically the last slide is next steps or how you can partner with us. And so when you lay all that out in a framework, your entire presentation or pitch deck should be, somewhere between 17, 20, 25 slides or whatever, but it's something that you can get through typically in about 20 minutes. And if it's longer, you want to condense it, or if there's a lot of information, put a little tab in your presentation. Put the important stuff up front as to the team, the project, the returns, the structure, and then say, in the back of the pitch deck behind the tab, there's an addendum. We go into the financials there. There's some blueprints or there's some floor plans or whatever. And you can go through that, Mr. Investor, at your leisure. So, you can put that stuff in there, but put it in the back behind an addendum so that it supports the underlying message, and it just really adds to the presentation itself. That's how you want to approach it.
Yeah, I found like 90% of the time, and we basically kind of limited it down to that like investment overview,
Yeah, there you
that
go.
in a conversation, people don't like to sit here and have a PowerPoint presentation handed to them.
Exactly.
It's just awkward. But they may want to be able to have like 5 or 6 key points that you can walk through the highlights of the project, talk about
Mm-hmm.
your people, and then be able to hand that back to them that they can look at it later. So
Absolutely. Totally.
it didn't hurt to have the thicker packet, but we didn't sit there and flip through it.
Yeah.
Allow people to know, like, on a high level, here's the big things that you
There you
resonate,
go.
that give you a return. People are wanting to understand what's the benefit to them, and then they can pass this over to their CPA to do these numbers, check out, and pass it back.
Yeah. Absolutely. You got it.
One of the things we struggled with a little bit was timing on when to put together our subscription agreements. Some people
Mm-hmm.
do a PPM versus we ended up doing a subscription agreement and operating agreement.
Mm-hmm. Yeah.
When do you think it's appropriate to do that? And what do you think is required before you start pitching, a deal to somebody?
Well, I mean, you can pitch and you can build interest and get what we call maybe soft commitments, indications of interest. But at the end of the day, it doesn't matter whether it's one or whether it's 100. You understand? You're in the securities business, so it's
Mhm.
your obligation to provide disclosure document to the investor. and provide basically something that they can use to do proper due diligence. Now, that's varied and very different for non-accredited investors versus accredited investors. But at the end of the day, you do want to have kind of the makings of a private placement memorandum. And in that, typically there's going to be an operating agreement, there's going to be subscription documents with a checklist, and of course the information we need to properly onboard people. So it's very good that you went in that direction and had help putting those things together. I think the biggest mistake that a lot of people make is number one, failing to provide total disclosure. And in the world of securities, there's a body of law that we need to understand called an omission of material fact, which means if you don't tell me something that had I known it would have led me to make a different decision about you or about the deal, that's fraud. That's misrepresentation. You're guilty of something in the securities industry because had I had full knowledge, my decision to invest might have been very different. So as an example, somebody might have filed for bankruptcy 7 or 8 years ago and they try to sweep it under the rug. Well, it's not such a bad thing if you explain it to somebody and it was in a completely different industry, in a completely different economy, for completely different reasons. But if you don't tell that to me and then I find it out later after I invest, if it would have changed my decision, that is what we call an omission of material fact, which is pretty serious offense. The other is what I call the small things that a lot of people just don't do. When you're raising money, there are certain procedural things that we also need to be aware of, that we also need to do. And one of them is we need to claim the exemption from registration, and that is through the filing of what we call your Reg D notification filing with the SEC, which procedurally is usually done by your attorney or somebody that has knowledge of how to log on to the SEC website and obtain what we call your CIK number, which is just a registration number for your offering, and then essentially just make your fund effective. It means we're notifying the SEC that we're relying on this exemption. We're now in capital raising mode. But then it's also the next step is notifying the states that we're actively raising money in and procedurally doing what we call our blue sky notice filings. And so a lot of people are just off to the races raising capital. They get on social media and they get investors in Arkansas and they get investors in Florida and they get investors in Georgia. They get investors in, all these different states because they're using social media. And all it takes is just one unhappy person. And as they say, the shit hits the fan. What that plaintiff's attorney is going to do is he's going to depose you and say, where do you have most of your investors from? Well, we got investors here and here and here. And then he's going to go and he's going to see you did not file your blue sky notice filings. You have broken the law. Hence, you're guilty. And now the investors are going to be sent letters. Would you like your money back? Because in the world of securities, if you violate any of the rules, you give investors what we call the right of rescission. They get their money back because you didn't source the capital properly. You didn't do certain things that procedurally you're supposed to know. So, as part of our platform, we really teach people all of these things and we tell them, stay in touch with your team, let your attorney know, or make sure that somebody is reporting to somebody that's going to stay on top of these regulatory compliance issues so that you remain fully compliant throughout the whole process, so that you don't bring any problems to yourself. Because, the world of securities is one, unfortunately, where you're taking people's money. People do a lot of funny things when it comes to money. And as I like to tell people, sometimes just bad things happen to good people. You have no control over it. I get it. We had COVID. What happened? A lot of people, of course, lost businesses. A lot of properties failed. We have hurricanes. We have tornadoes. We have a lot of things that can affect the returns to a potential investor. No volition of your own. But again, it just comes down to that one unhappy person picked up the phone, called a regulator, called a plaintiff's attorney, decided they wanted their money back because they felt that they're screwed or they felt you misrepresented something. And if you don't do things properly, it can come back on you. So those are some of the things really that I think we need to focus on. And I think, unfortunately, a lot of people out there that are in this space are not talking enough about those things because, number one, they've never been licensed or regulated like I have. Been licensed for 30 years. I got all my securities registrations for a long time. Most of the other people have not. Or number two, they're focused more on this is how you raise capital. These are the things you do. And they're kind of, I won't say turning their back to the regulations, but they're not talking about them to the extent I think they really need to be doing. Because our job at the end of the day as coaches or mentors or trainers, whatever you want to call us, It's not only teach you how to raise capital, but it's also how to do it right and make sure that you don't become a target or you don't fall prey to any problems that would potentially cause you litigation, thousands of dollars in legal defense, et cetera.
So one of the first early categories on figuring out what bucket we were going to raise capital in was, 506B versus 506C.
So, you know,
And that kind of laid out how we were going to have conversations and how we could reach
yeah,
out to people. Maybe
right.
talk a little bit about the distinction between those two and what's primarily allowed in one bucket versus the other that you ought to be careful about as a capital raiser.
So when we raise capital, we're in the securities business. And typically what that means is we have to file registration notice with the SEC, go through this long, expensive process, unless we can find what we call an exemption from registration. And one of the most popular exemptions is what we call Regulation D, or as you said, Reg D. And so there's a Reg D 506B and there's a Reg D 506C. And really, the decision as a business owner is, do I want to work with friends and family, or do I want to work with people that might not be accredited investors? And an accredited investor typically is somebody that has earned $200,000 in the two most recent years with the expectation of earning that in the current year. Or if they're married, it's $300,000 combined with their spouse. If they don't meet the income threshold, it's $1 million in total net worth. Now, the other flip side is that you have to have, if you choose to do a 50B and work with these people, what the SEC defines as a substantive existing relationship. Like you have to know them. You can't solicit, you can't advertise. You need to build that relationship over time before they invest with you. Conversely, if you want to advertise and you want to use social media and you want to leverage, the internet and do funnels and all that, you can do what we call a Reg D 506C. But now all of the investors have to be accredited. But there's some advantages to that. With a 506C, because it's assumed that they're all bigger investors, they all can handle a small financial loss, you're not required to provide as many disclosures. The disclosure burden and the transparency on financials that you have with non-accredited is not as great. So a lot of people choose to go that route and work with accredited investors. Now, here's the interesting thing. Under the new administration, with Paul Adkins coming in as the new head of the SEC, they're kind of redefining the terminology on that. It used to fall on us as capital raisers, where we needed to actually verify that the person investing was indeed an accredited investor. We could not take their word for it. We had to go through this verification process to ascertain that they actually were. Well, that's changed recently. And the change is now if a person is investing $200,000 or an amount greater, or if it's a larger institutional type investment like a trust or a family partnership and they invest $1 million or an amount greater, we don't have to go through the verification process any longer. We just take their word because the investment size is sufficient enough to substantiate they're accredited at that. No one's going to write you a check for $250,000, if they're not a millionaire. But they're now expanding it even further to allow people to pass an examination to become an accredited investor. Think about it. People that work in the financial services industry that have taken all these financial regulatory exams have such vast knowledge of investments that they understand the risks. They understand the investment world. Why not say, hey, you can become an accredited investor as well? Because I think that when you really look at the definition, it's backwards. I don't think that you should be deemed an accredited investor not based on your level of wealth. I think it should be based on your knowledge of the investment and the risks and the potential for a return. If a guy makes $120,000 a year and he's only worth $750, but he's read books on investing and he's invested with other people and he's got his financial services designations and he practices as a CPA, that guy should be an accredited investor in my mind, because he understands the risk, he understands the investment, he knows how to read through an offering memorandum. And so I think that, the SEC under the new administration is really going to change the landscape and kind of redefine and open the door to many more potential accredited investors for all of us to approach, which I think is a really, really great thing for capital raisers. It's going to make our job much, much easier. So I'm really excited to kind of see what the next, 2 to 3 years look like as we kind of expand and redefine what an accredited investor actually looks like.
So if I'm an investor, what is the benefit for me typically to be investing into projects versus, say, alternatively going and investing into stocks or mutual funds or that sort of thing? And maybe specifically in our category, this is the Radical Hospitality Podcast. We're talking to real estate investors, specifically in the hospitality realm. Why would an investor be looking, and what would be the benefits to them to invest in this type of asset, and what type of returns should they be looking for versus something else?
Yeah, that's a great question. First of all, I think your listeners need to understand the difference between what we call traditional investments, stocks, bonds, mutual funds, cash, bonds, things, ETFs, things that largely are correlated to the stock market. A lot of people think that they're investing in real estate when they buy a real estate investment trust. No, you're not. You're buying a stock because that REIT is highly correlated to the stock market. Market drops, that REIT is going to drop right along with it, like a rock. And I've actually written an article about this, which is the difference between investing in public real estate versus what we call private real estate through a syndication or a private fund. The big thing, and your listeners can Google this, when I talk to an investor, one of the things that I believe is my role is to do a little bit of educating. And I talk about this thing called the endowment theory, which is how the largest endowments around the world invest their capital. And so if you look at their portfolio, it looks like a pie. And there's all these little pieces. There's international equities. When they invest in the stock market, they're not just buying Amazon and Facebook and Apple, they're buying equities of companies in other countries because they're diversified, international and domestic equities. Real estate, they're not only investing here, they're investing abroad. They own real estate in London. They own real estate in Australia. They own real estate over in the UAE. When they invest in things like private equity, they're buying into businesses. They're investing in natural resources. They're investing in commodities. They're maybe investing in what we call antiquities, coins, rare stamps, gold bullion, whatever. So think of yourself as an investor. If you say, yeah, I'm diversified, man, I got 12 stocks. I have some Facebook, Amazon, some Apple, some Nvidia. What's happened to you in the last 3 weeks? Well, I've lost about 30% of my portfolio. That hurts. Think about this. If you'd owned some real estate, which is a tangible asset that really hasn't dropped in value, and maybe you'd invested with somebody in a natural resources drilling program where you're getting some monthly income, and you'd invested maybe in a private equity fund and you got some gold, you're much more diversified. And so really as an investor, you don't want this roller coaster ride. What you want is just steady, predictable growth where you can sleep comfortably every night knowing you're making your 12 to 14% a year. And so that's really the message. Real estate as an asset class is tangible. It goes through cycles, but it ain't going to drop as dramatically as the stock market does. And I tell people that are in real estate that are raising capital, you got to focus on three things that real estate provides, which is what most people are looking for. They're looking for the capital appreciation and the growth in their capital. Number two is they're looking for income, which is what most real estate projects generate. Whether you choose to distribute that monthly or quarterly is up to you. And they're looking for the tremendous tax benefits that we derive from real estate. So talk about all of those three things. But see, like I said very early in the show, our job is to find out what the temptation is for that person. If I'm talking to a surgeon and he says, Zeke, man, I'm a doctor. I make $750,000 a year as a surgeon. I pay way too much in taxes. Pitch your investment and talk about the tax benefits. Can you see, Dr. Jones, how the depreciation and the things that we get to write off, which are all the capital expenditures like the insurance and like the utilities and like any repairs, are going to help shelter your income because it's passed through directly to you? Yeah, see that. That again is why you should invest, right? So it's not that I'm focused on this, I'm focused on that for that particular investor. But the great thing about understanding investments and really educating potential investors is to pitch or present what you have in light of their portfolio, but really also talking about how a properly diversified portfolio is going to weather the storm, is going to help them get where they want to be. It's going to provide a much more stable retirement. And so I think it's a lot of just really having conversations with people, but really also understanding the business you're in and how that business stabilizes their portfolio, because most people really are not nearly as diversified as they should be.
Yeah. One of the things I've been really surprised about in our pool of investors is a lot of the investment ended up coming from other real estate investors that may be,
Mhm.
clients that are looking to do similar things like boutique hotels
Right.
or, other real estate investment, and they may be raising capital for their own area. But
Mhm.
you're really, as an investor, you're looking at investing in that person and maybe in that particular market, and they may be better positioned to run that particular project because it's a lot of work to get that project together and
Mhm.
done
Right.
than you may. So you may want to have a vacation home or be part of a project in a particular part of the country. Well,
Mhm.
you may not want to relocate there to do that project, but you might be able to invest with an expert that's in that doing that. And vice versa, as we've looked at our portfolio, which is diversified in real estate as well as treasury bonds and stocks, and we look for and we have a self-directed IRA,
Yep.
and we looked for the returns on that self-directed IRA. It became more difficult than we thought to be able to invest in our own projects because you can't self-benefit.
Right.
As an architect, we're going to design our projects. As one of the benefits that we bring to a project. Well, we can't invest into
Exactly.
projects that we're actually paying ourselves, and so that's a window where we have begun to looked at other hospitality investors to say, well, I want to invest with that person, and I've got this pool of funds. I can't invest in myself because I want to be in that market. I want to build that relationship. I want to be able to
Mhm.
collaborate and do things. And it becomes much more of a collaborative joint sport than I ever imagined, that we are investing in each other's deals and supporting each other's versus this competitive thing, because it really has that great of a benefit over I'm watching my stock portfolio diving, and I know I'm offering a much better investment over here
Right.
that I would invest in if I could, but I'm going
Yep.
to use that to build relationships. And so I think that has been an interesting turn for us to kind of learn, like, how much, if you're helping other people, that you'll end up helping each other um,
Mhm.
in this
Mhm.
process.
Yep, I agree. I mean, I think that, if you've been in the stock market and that's all you've had the last couple of weeks, you're catching a falling knife. That's pretty much how you feel right now, right?
Yeah.
So, imagine, of course, if you were much more diversified, yeah, your stock portfolio's gone down, but your real estate portfolio's held value. And, if you invest in crypto obviously is a whole asset class. Maybe that's gone up. And, maybe you've invested in some oil and gas and you're getting checks every month from that. So you don't feel as bad. It's all about having proper diversification so that, you're not having such dramatic drops over short-term time horizons.
So maybe the last topic is, as we've gotten into, we went from, early on building the relationships to building investment decks to be able to send out to people, to then letter of intents, and then to subscriptions and getting people to subscribe, to, finalizing, the debt service with all that. Now we're kind of moving to this phase of like capital management. And one of the things that we dug into was finding a platform that made it easy for our investors to be able to
Sure.
see their returns. And so, we brought on Cash Flow Portal to kind of help manage that. What do you recommend in terms of, cash flow management so that it's clear, and what are the best practices as you're moving into, long-term
Right.
distributions and that sort of thing?
Well, I think you're definitely doing the right thing to have a investor onboarding slash reporting portal to provide greater transparency, have one centralized location for all of those things. Makes it look a lot more professional, makes it a lot easier to manage. Number two, obviously, you want to have some type of a accounting type relationship to make sure somebody is keeping the books, dotting the i's, crossing the t's, and at the end of the year, providing a level of reporting to the investors. And then, of course, three, At a minimum, I believe you should be sending out a newsletter quarterly to just update your investors on the activities related to the project. Here's what's going on. Here's what we're doing. If you just take somebody's money and then they largely don't hear from you over an extended period of time, there's obviously going to be tremendous concern. And so you really build that trust on the back end of the relationship. Yeah, raising money's hard. There's no doubt about it. But really, I believe the hard work starts after you have the money, because now you have to become a good steward of the capital. And the better you do that, the easier your capital raising will become in the future, because now you can finally go full cycle on the trust sequence, which was what we get to the very sixth step. We call that affiliation. They become your affiliate. They become your messenger. They open up their networks. They say, hey, Zeke, my friend just sold their business and they're looking at opportunities. You guys should connect. He's sitting on a couple 100,000. And so, the people that you start bringing on as investors all have their networks. And, one of the things that I'm a big believer in is that you need to seek their network by asking for referrals properly. Once you know you've built their trust, once you know they're somewhat satisfied, why would they not want to open their network? So it's just a matter of, asking who are you connected with that we should also be speaking with on our next project. And hopefully they name drop a couple people, and then they send out an introductory email or they send out an introductory text. And again, it's very similar to the principle we discussed before. I don't have to spend nearly as much time building trust because Brad told me that you're a great guy already. And so now let's just talk about the deal. And so you can compress the time horizon to some extent and hopefully get to the point of investing much quicker with a much greater degree of certainty. And so I think that that's really the answer to that. But it really just, it all comes back to having a system in place. And I think one of the things that Cashflow Portal does as a tool is it upscales you where you're not just sending stuff out as an attachment. It's like, hey, we're going to invite you to our deal room. Here's a link. The first thing you're going to do is you're going to basically register at the platform to then get entrance to the deal room where you can look at our pitch deck. You can go through the PPM. Some people, of course, upload videos, which is a great way to sell the opportunity as well. But the great thing for us is we're notified. John just registered at your Cashflow portal. Well, now you got a lead. And now you can pick up the phone and call out to that person the next day and say, hey, John, this is Zeke over here. Thanks for registering at our portal. What is it about our opportunity, or what is it about our program that caught your attention? And so, now you use that platform not only to host your content, it becomes also a lead generation opt-in tool for you as well if it's used properly.
Mm-hmm. So if I'm a real estate investor and I've been doing some fix and flips or, Airbnbs over the last few years and, basically using my own money or maybe, one or two other investment partners, why or what would be the benefit to start moving to capital raising? And when would it be appropriate to start looking at capital raising and using other people's money?
I think anytime you're ready to go, it's time to go. In the book Rich Dad Poor Dad, Robert Kiyosaki says, understanding the OPM game and learning how to raise capital, that's the secret. Like, you can scale, you can grow, you can build a legacy. There's only so much we can do with our own limited capital. But once we understand how to raise and attract capital, it just opens up a whole world of opportunity. Imagine having the ability to raise $1 million, which is, in the grand scheme of things, not really a lot. But for most people that are your listeners, that's life-changing money. They can do a couple small deals. Over the course of a year, they could walk away with a couple $100,000 in profit just on that amount alone, flipping houses or investing in single family or small multifamily, a couple fourplexes.
Or
Most
boutique
people
hotels?
don't have the ability to do that themselves. So literally understanding how to borrow capital, as I like to say, it gets you a seat at the bigger kids table. It gets you bigger deals.
I love it. So, Brad, I really wanted to bring you on today because a lot of our audience and a lot of our clients with Root Architecture are looking at ways to be able to scale their portfolios, their size of projects. If somebody wanted to dive into this further, learn how to do this, what's the best way for them to start to engage with you?
Yeah, just reach out to me. I'm all over social media. And so on Instagram, you're just going to look for me. It's just, Brad Blazar, Blazar. There are no E's at all in the spelling of my name. It's Brad Blazar. And you'll see the little blue check mark that says you're talking to the right dude. Just send me a DM. If you want to send me an email, my email is real simple. It's just bradblazar.com, and just say you heard me on Zeke's Radical podcast and you'd like to know more, a little bit about what we do and how we can help you, we've got all the tools and all the resources you need, from the systems, the pitch decks, launching funds, relationships with 5 law firms, boot camp. So we'd love to help any one of you that are struggling in the capital raising journey and help get you from point A to point B. Teach you how Zeke raised, his $2.5 million and how you can raise a few million too to get your deals done. And then, of course, if you're already actively capital raising now, great, congratulations. Let's show you how to build those relationships that can 5 to 10x that, like I talked about, which is, understanding where to find these small boutique registered investment advisors, coming to some of these family office networking events with me where I open the network and I say, come on in, attend right alongside me. Let me introduce you to some of the people I know. And so that's how we help people in our community. And that's how we give back to others that really want to learn how to do this. And more importantly, just, do it the right way.
I love it. Appreciate you spending some time talking through this. Again, I believe real estate can be life changing. And I think learning how, especially in this times when interest rates are high, stock
Mm-hmm.
market is insane, there is a lot of interest and a lot of opportunity to help each other by
Yep.
learning to raise other people. And remember, we're part of that other people. It's not them. It's, hey, it's learning how to do this ourselves
Right.
outside of all of the government agencies, all of the, you know, uh, regular banking systems so that we can get deals done. So
Absolutely.
it really is a grassroots effort to get real estate done that is life changing, that makes community impacts. So, Brad, thanks for doing what you do. Thanks for being on the
Appreciate it.
podcast. And I hope you keep rocking it out there.
I appreciate it. Thanks so much for being a great host and, more importantly, asking some great questions that I hope added a lot of value to your listeners today.
All right. Thank you.